On December 20th, 2012, the hedge fund manager Bill Ackman took the stage at a Manhattan auditorium and opened a presentation running to 334 slides. Most investors put $1 billion into a company hoping to watch it grow. Ackman put $1 billion against one, betting that it would fall to zero. His target was Herbalife, a global nutritional supplement company he publicly called the largest and most sophisticated pyramid scheme in corporate history. Ackman didn't just short the stock. He announced on television that he intended to hold the position until Herbalife's stock hit zero, however long that took, and he pledged that any personal profit from the trade would go to charity, not into his own pocket. Within hours of that presentation, Herbalife's stock had lost more than a third of its value. Investors watched a billion-dollar company get gutted live, in real time, by a single slideshow. A short position carries a risk, a normal investment doesn't. Buying a stock caps your loss at what you put in. Shorting one has no such ceiling. If the stock keeps climbing, the losses keep growing with it, without limit. Ackman was betting his fund's money and his own reputation on a single conviction, without knowing he was about to run into the one investor on Wall Street most willing and most able to make him pay for it. Herbalife was founded in 1980 by Mark Hughes, who started out selling protein shakes from the trunk of his car in Los Angeles. Over the following 3 decades, it grew into a multi-billion-dollar company operating in more than 90 countries. On paper, Herbalife sold nutrition products. In practice, most of its revenue moved through an enormous network of independent distributors, and the real money in that network came less from selling shakes to customers than from recruiting new distributors underneath you, who recruited more beneath them. Ackman's investigation went further than reading spreadsheets. His team quietly sent people to distributor recruitment meetings, posing as potential recruits, to record the sales pitch from the inside. One of those operatives was later revealed, in press reporting, to have a prior fraud conviction. An embarrassing detail Herbalife's defenders used to question the credibility of the whole investigation. His conclusion was blunt. The large majority of distributors earned almost nothing. Some had gone into debt buying inventory they couldn't sell, while a small number at the top of each chain captured most of the money. He believed that once regulators saw what his team had documented, the company wouldn't survive the scrutiny. Ackman assumed the facts would speak for themselves. He hadn't accounted for Carl Icahn. The bad blood between them went back a decade to a failed real estate deal involving a company called Hallwood Realty. Ackman had sued Icahn over it, won, and by his own account had to threaten Icahn with contempt of court before Icahn finally paid what he owed, with interest. Icahn never forgot being forced to write that check. When Icahn saw Ackman publicly commit $1 billion to a short position, he recognized something Ackman's presentation hadn't addressed. Anyone with enough capital could push the stock price up and make that short position more expensive to hold. On January 25th, 2013, a few weeks after Ackman's presentation, Icahn called into a live CNBC broadcast where Ackman happened to be on the air. What followed became one of the most replayed exchanges in financial television history. An on-air argument between the two men that ran for nearly 45 minutes and stopped being about Herbalife within the first few. Icahn told Ackman on live television that he had no respect for him, questioned his honesty in front of millions of viewers, and mocked his pedigree. Ackman accused Icahn of running a personal vendetta dressed up as an investment. Shortly afterward, Icahn began buying Herbalife stock, and he wasn't alone for long. Other high-profile investors, including George Soros's fund and Dan Loeb's Third Point, took their own positions on the opposite side of Ackman's bet. None of them needed to believe in protein shakes or distributor networks. They only needed Ackman's short position to stay open long enough to become expensive. At one point, Icahn floated something more aggressive than simply buying shares. Taking Herbalife private entirely, which would have forced Ackman to close his short position on Icahn's terms, at whatever price Icahn chose to pay. For the next several years, the fight played out across financial media, political offices, courtrooms, and at one point, a federal investigation into Ackman himself. Ackman pursued every avenue available to him. He hired public relations firms, lobbied members of Congress, funded advocacy groups organizing protests, and backed a documentary about the company's business practices, later released as Betting on Zero. Herbalife fought back the same way, and reporters later found the company had been quietly funding some of the community and civil rights organizations that were publicly defending it, a detail that turned Herbalife's own grassroots support into a controversy of its own. The personal cost to Ackman went beyond money. He said the campaign brought him threats serious enough that he took on personal security. At an investor conference in 2014, his voice broke and he had to pause while describing what the fight had cost him. Around the same time, federal authorities opened an inquiry into whether Ackman's own campaign against Herbalife had crossed into illegal market manipulation, a so-called short and distort scheme. The investigation never led to charges, but for a while, the man trying to prove a company was running a scheme found himself being investigated for running one. The financial pressure eventually forced Ackman to change tactics. In 2014, rather than keep the open-ended short position that could theoretically cost him an unlimited amount, he restructured much of the bet into put options, a version of the trade with a fixed, known maximum loss. It capped the bleeding, but it was also a quiet admission that the position as originally built had become too dangerous to hold as is. Icahn kept buying. Eventually, he controlled more than 20% of Herbalife stock and held seats on its board. Every dollar that pushed the share price higher didn't just cost Ackman on paper, it increased what his fund had to post as collateral to keep the short alive, turning the standoff into a slow-motion margin call. In May 2016, after a 2-year investigation, the Federal Trade Commission announced a settlement with Herbalife. The regulators validated much of what Ackman had argued. They fined the company $200 million and required it to restructure how distributors were paid, tying rewards to actual retail sales rather than recruitment. It was a serious public rebuke, and briefly, Ackman's side looked vindicated. But one detail in the settlement undid the trade entirely. The FTC didn't call Herbalife a pyramid scheme, and it didn't shut the company down. Herbalife paid the fine, adopted the new rules, and kept operating. Freed from the threat of a government shutdown, its stock price rose instead of collapsing, climbing well past where it had traded before Ackman ever took the stage. By late 2017, the strain on Ackman's fund was hard to ignore. Investors in Pershing Square had grown restless after years tied to a trade that wasn't paying off, and some pulled their money out entirely. In March 2018, Ackman closed his short position on Herbalife. After 5 years, hundreds of public appearances, a federal inquiry, and tens of millions spent on research and advocacy, he walked away with an estimated loss of roughly $1 billion. Icahn held his shares as the price kept climbing and eventually exited his own position years later with an estimated profit of close to $1 billion on the other side of the exact same bet. Ackman wasn't entirely wrong about Herbalife. Regulators forced the company to rebuild the exact part of its business model he'd spent years exposing, which suggests his research had found something real. Where he miscalculated was a rule Wall Street has repeated for decades, one popularized in the 1990s by the analyst Gary Shilling. Markets can stay irrational longer than any single investor can stay solvent. Ackman had treated the market like a courtroom, where the facts eventually decide the outcome. Icahn treated it like an arena, where whoever has more capital and more patience decides who's still standing at the end. In this one, being right and winning turned out to be two entirely different things.